On Schedule A, charitable gifts and casualty losses are two places the IRS asks, prove it. On the EA exam, they love the substantiation thresholds because missing one piece of paper can wipe out the whole deduction. Today, focus on three buckets: cash gifts, non-cash gifts, and personal casualty losses. Then we'll finish with the weird, miscellaneous itemized deductions that still survive TCJA and ABA. Start with cash donations. For any cash gift, you need at least a bank record or written receipt. The big exam line is $250. If any single cash contribution is $250 or more, you must have a contemporaneous written acknowledgement from the charity. It needs the amount, the date, and whether you got goods or services back, plus a good faith value estimate if you did. Non-cash gifts have more moving parts. Under $250, you generally need a receipt and your own list of what you donated. From $250 up to $500, you still need the receipt, but the acknowledgement must also address goods or services received. Once total non-cash deductions for the year exceed $500, Form 8283 is required. And if any single item or group of similar items is over $5,000, you're in qualified appraisal territory and Form 8283 Section B. A couple of nasty add-ons. If artwork is over $20,000 or property is over $500,000, the appraisal has to be attached to the return, and vehicles are their own trap. If you donate a car, boat, or motorcycle and the charity sells it, your deduction is usually limited to the gross sales proceeds, and you attach Form 1098-C. If the charity keeps and uses the vehicle, you can generally deduct FMV, but you still need the written acknowledgement stating the intended use. Now, casualty losses for personal use property. TCJA suspended most personal casualty and theft losses, and ABA made the key limitation permanent. You only get a personal casualty loss on Schedule A if it's from a federally declared disaster. Then you compute the loss as the lesser of the drop in fair market value or your adjusted basis, reduced by insurance reimbursements. If it's not a federal disaster, it's usually a sad story, not a deduction. Also know the special disaster relief rules that show up in questions. The Federal Disaster Tax Relief Act created qualified disaster losses for certain major disasters in a specific date window. The normal personal casualty limits are a $100 reduction per event and a 10% of AGI floor. For qualified disaster losses, the 10% AGI floor is removed and the per casualty reduction becomes $500. These are claimed on Form 4684. Finally, the miscellaneous itemized deductions that still exist. TCJA killed the 2% of AGI miscellaneous bucket, and ABA made that permanent, but some items remain deductible on Schedule A. The exam favorites are gambling losses, limited to gambling winnings, and impairment-related work expenses for a person with a disability, which are deductible without the old 2% floor. You may also see things like IRD estate tax, claim of right repayments over $3,000, and certain Ponzi losses. Marina is a self-employed accountant. She took her best client to a hockey game. The event was sold out, so she paid $200 for both tickets through a scalper, almost double the $60 face value each. After the game, they went to dinner and discussed business. The meal cost $80, and the taxi to the restaurant cost $20. How much can Marina deduct as a business expense? Think about it. The answer is $100. The hockey tickets are entertainment, and entertainment is still non-deductible, even if you talk business. The tempting wrong answer is $80, because people forget transportation. Under the 2026 rule in the question, business meals are 100% deductible, so the $80 dinner is in. The $20 taxi ride to the restaurant is also a deductible business expense. Total deduction, $80 plus $20. Diana is 80 years old and donates to charity throughout the year. She has a traditional IRA and must take an RMD. She decides to make a tax-free gift directly from her IRA to her church as a qualified charitable contribution. Her 2023 AGI is $80,000, all from passive investments. What is the maximum amount Diana can withdraw from her IRA tax-free as a QCD? The answer is $100,000. A qualified charitable distribution from a traditional IRA to a qualified charity can be excluded from income up to $100,000 per year. A common trap is picking $80,000 because you anchor on her AGI, but the QCD limit isn't based on AGI. Also, a QCD can satisfy all or part of the RMD if it's made by the RMD deadline.